The presentation is going to focus as specifically as possible on what is the whole agenda of GCC Economic Union with respect to what's happened in the European Union. So to keep things brief and short, let me just tell you how this all began. In 1981, 6 countries in the GCC, primarily Bahrain, Kuwait, Saudi Arabia, Qatar, Oman, and UAE, they came together and formed what is called the Gulf Cooperation Council. This Gulf Cooperation Council essentially was formed as a future where you would have all these countries work together and become more and more integrated in terms of their cooperative initiatives, collaborative initiatives, trade, movement of labor, capital, investments, financial markets, research, innovation, and so on and so forth. So this was the primary idea why this GCC was formed. Also, one of the last but not least criteria of GCC cooperation was to move away from their individual currencies and form one single currency called the Khaliji. So Khaliji was envisioned in 1981. In 2002, that was long after this happened, the GCC economies then pegged themselves to the dollar. So all the GCC currencies of all the 6 economies pegged themselves to the US dollar. The whole idea was by 2010, these economies will move to a single currency called the Khaliji. Now, when you talk about why would they want to create this kind of integration, why would they want to move from all these individual economies to one big economic area, they took the example, obviously, from the European Union, without getting into the controversial issues of Brexit and what's happening now. I'm going sort of back, rewinding time, back to when it was formed and how it has gone in the initial stages, till about Greece came into the picture. So this was when GCC, if you look at the GCC economies individually, they are very small. But if you look at them integrated, if you look at their total income, total population, total foreign exchange reserves, they are a massive block. So there's a big potential there. Also, integration means a lot of things. Integration means you can do trade better, you can buy and sell your goods better, you can attract investments better, you can have mobility of your labor, as you have seen across the European Union. All these reasons had sort of inspired GCC to move into that direction. However, it has taken a long time and progress has been very, very slow. So if I look at the various kinds of integration we talk about, GCC has created what is called a free trade area, so they can trade without barriers. There is no tariff, quota, duties imposed if you are trading within the GCC. And there's a customs union also in the GCC formed now. This customs union means that you can import and export without any duties within the GCC, plus only if you are not a member of the GCC, a tax would be imposed when you want to export to the GCC. So that's great. The third thing about integration is the common market that was also created. Very recently, GCC has talked about free movement of labor across all the 6 countries for jobs, for employment. It has also looked at investments in real estate. Anybody, a Qatari national, can invest in Saudi, Saudi can invest in Bahrain, and so on and so forth. So there is a genesis of a movement towards integration as we know it. Obviously, it's far away from what we have experienced in the EU, and it is still in that process. So if we look at the benefits, integration means a lot of good stuff. But the final word of integration is when you have a monetary union. That is when you abandon your individual currencies and you move to one single currency. That's what European Union, the Economic and Monetary Union, has done. So Germany, France, Italy, and so on and so forth, 27 countries are using one single currency. So that was the whole idea of the GCC. So the question is GCC ready for that economic union? That's the whole question of this paper. do you see GCC, or do we see GCC as an area which can handle a single currency? Before we move on to this concept of single currency, it's important to understand, or probably all of you know that already, is what the role of oil plays in the GCC economies. Because that is still now a very big determinant as well as a detriment for the economic union. So it's a controversial thing. First of all, it's great that there is oil and it's so much of richness that it has provided to these economies, but also is a big detriment towards this kind of a union. So I will try to explain that as quickly as possible in the brief time that I have. So if I look into GCC economies, I'm not going to give you the statistics, but just to let you know, if we put GCC together, it's a fantastic block. If you look at them as small countries, there isn't much. There isn't much that they can do. So why is oil so important? Because oil determines, apart from the fact that GCC has so much of reserves, it contributes so much of oil to the global oil production on the daily basis. Oil essentially drives these economies in terms of the income, in terms of their export earnings, and also in terms of their import capacity. If they can't export oil, then they do not have the ability to import, which drives these economies. There is very little diversification in these economies. So that's where sustainability is also coming into the picture. One important thing to understand here is, if oil is so important, how important is it for these individual economies? If you look at this graph, the break-even price of oil determines the resilience of these economies to oil price. What does that mean? So if you look at Bahrain, which is at the top, Bahrain's government can balance its budget, meaning the government expenses will be equal to the government revenues only if oil price is $121 per barrel. So that's the dependence of Bahrain on oil to budget, to have a balanced budget in its government. So if you look at the various break-even prices of oil that we have shown, it's Kuwait and Qatar which are most resilient to oil prices, which is around 50 and below for a long time now. But the rest of them, and especially Oman and Bahrain, are very, very exposed to this oil price. So what does that mean? You have a situation where you have little or no diversification. 70 to 80% of your income depends on oil. You are tremendously dependent on it. With oil prices going down, your budget is not balanced. That means your government has a deficit. That deficit eventually will have to be covered. So this is the current situation in which most of these economies are. So what does that mean from an integration perspective? So what I did here was, I will not get into these details. What I did here was I looked into what were the European Union countries doing when they wanted to become a single currency zone. They went through an exercise which was called the Convergence Criteria. They sat together and they decided if all these economic indicators were moving similarly across these countries over a period of time, then these economies will finally be able to abandon their single currencies and move to one currency. So they carved out a convergence criteria where these economies will be converging. So they looked at all these criteria and put together these criteria. Given the lack of time, I'm only going to highlight two criteria here. That is important for GCC. So I tried to use these criteria and plugged them into the GCC scenario and tried to observe how these GCC economies are behaving for one whole decade. So what has been their behavior in terms of these economic parameters? Are they ready to converge? Are they ready to be aligned so that they can start using one single currency? Surprisingly enough, or probably not surprisingly enough, most of these economic criteria which we used work well for the GCC economies. So they look very similar. Well, it is not surprising because their economic structures are very similar. They are highly dependent on oil. There is little or no diversification except probably UAE. They have very similar cultural backgrounds, socio-economic backgrounds, language, and many, many other things which are similar. Even their labor force population is very similar. They have almost 50% expatriate population, 50% indigenous population. So given these similarities, it is not surprising that the economies are very much moving together. So most of the convergence criteria are satisfied. What we observed in European Union, we see pretty much similar. In fact, European Union countries are way dissimilar among one another. They have different specializations, they have different language, different cultures, different manufacturing specialities, and that is where a lot of trade happens between EU. But that trade you don't see in the GCC because they are very similar. They have oil and very little of something else to trade. So going back to this, seeing how the economies are moving, there is one area or probably two areas where the GCC economies do not move together. And the signals or the red signals are coming from the deficit to GDP ratio. So what convergence criteria says is your deficit to GDP ratio should be around 3%. Then if these economies can provide that kind of a deficit, which is, what is the deficit? Government spending minus government earnings. So if the deficit is 3% of GDP for all the economies, yes, they are converging. They can look into a monetary union. So if you look at this, this is where the red signals are coming for a GCC union. Because in this period of low oil price, most of these economies are not able to balance their budgets. They are seeing rising deficits. So the government expenditure has gone way above the government earnings. Where is the government earning coming from? Primarily oil. And that price has gone down. So obviously now that deficit in the government budget is going up. So it doesn't satisfy one of the important criteria for moving towards an economic and monetary union. So this is the first red signal. What is the next one? Because of this deficit that each of these economies are experiencing, primarily Bahrain, Qatar, and Oman, the others are more resilient. You see that their debt to GDP ratios are also rising, which means the government is now having to go ahead and borrow money to meet this gap. So this means, and why is this a red signal for us? Because according to the criteria, the government debt to GDP ratio should not be more than 60%. That's the signal. If your government is borrowing more than 60% of what it earns or what its income is, then there's a problem. Here we find that we are reaching that kind of a red zone, especially with Bahrain. Bahrain's GDP, the debt has risen beyond 67%, though estimated, but it's more now, and all these numbers are way higher. So this tells us, in conclusion to what we have been trying to explore in this paper, I conclude that GCC economies are similar, they are moving together, but when it comes to low oil prices, these economies do not converge. They are not ready for an economic and monetary union. They should not abandon their currencies and move to a single currency. The reason being that their dependence on oil is so high that any shock to these economies from oil prices makes their deficits go high, and they're in different levels. All these economies are not similar when it comes to their deficits, surprisingly, because of the break-even price of oil. The oil price break-even is so different among the economies that they behave very differently when it comes to low oil prices. And because of these differences, their debt to GDP, their government debt is also very high for some of these countries. So they are not converging, they are diverging. If you look into this, sorry, page up. they are diverging. So there is no convergence as we can see. So in conclusion, the conclusion from this kind of an analysis shows, very simple analysis, but it shows two important results. One is that the GCC economies surprisingly do not behave similarly in periods of low oil price. They are not sustainable in terms of their economic growth. And number two, they have to be able to diversify enough to move away from their economic dependence on oil to be able to move together to a convergence, to be able to create a monetary union. If they are going to remain so similar, they will not be able to absorb shocks of oil prices into the system. They will not be able to grow sustainably, and obviously they will not be able to create the integration. So in conclusion, long-term diversification strategies and lower dependability on oil is extremely important, and sustainability of the EMU may be threatened in the short run. So if there's any movement towards a single currency in the short run, it will be threatened. Thank you.